About 1 year ago, I talked about Frontera Energy, and I wasn't that smart at that time. Today, I'm multiples smarter than a year ago because I have found out how to value oil companies, gold miners, silver miners, uranium miners with the NPV method and taking into account capex, interest, etc. And also taking a look at enterprise value. So I'm multiples smarter than a year ago. And here I said that Frontera Energy was a good buy. Well, let's do everything again, but with all of that knowledge that I have amassed. So a year ago, the share price was somewhere here, 12, and it has actually gone down to $9. So that's 25% lower. So not a good performance. And that's because I was not that smart. So I have created the chart again, but now I'm using the technique that I acquired in that time frame of a year. So what has changed now? So now what has changed is I added capex. This is the most important thing that I added. Money does not go to shareholders if it's being drilled, if that money is being put into equipment, etc., drilling holes. So this needs to be seen as a cost because that will be subtracted from the cash flow. And this is humongous, 350 million per year for Frontera. If you look at this chart, if we put this at 0, of course the whole chart goes up and the value goes up, but that's not the case. They do have a lot of capex. Other than that, also important is the debt. I haven't looked at the debt a year ago. Now we are going to do that. The debt is extremely important. Total liabilities of 1 billion. That's a lot of debt, 1 billion, for a market cap of 500 million. So they have quite a lot of liabilities that need to be paid off. Long-term debt at 500 million, and then some asset retirement obligations as well. So that's 600 million. That's a lot of liabilities compared to market cap. So we look at the enterprise value. Very important to do that. And that's about more than 1 billion. So that's also taken into account, which I didn't do a year ago. Then we take taxes, of course, look at the operating costs, which is actually very low compared to the revenue. So this is not a bad company, but it has humongous debt and capex. So what is the valuation? This is the valuation currently at 78 oil, 78 oil today with some natural gas liquids gas, but this is mainly an oil company. So it's very leveraged to the oil price. If this goes to 90, then you can see it jumps up. Yeah, it jumps up very fast if oil goes up. So keep your attention on the oil price. If oil goes to 65 like this, then Frontera Energy is not going to survive at 60 oil. So, yep, I think it's overvalued at this moment in time. There could be some downside, 20-30%, depending on oil, of course. Oil is up today, but if this goes down, then you can see that it went almost to zero. So a very high risk company, I think, because of the debt, 600 million in debt, which is the same as the market cap. So if oil goes down, please get out of Frontera Energy. If oil goes up, however, then everything is okay. Then they will have enough free cash flow to pay off the debt. Let's say oil goes to 90, which is possible. Everything is possible. Then you have free cash flow of 250 million. That's very good. Then you can pay off the debt of 500 million in 2 years. Okay. So everything depends on the oil price with Frontera Energy. They also own CGX. They had some drill results which were disappointing. That's this drop here. And yeah, I wouldn't take a lot of value for CGX. It's just an exploration play, not so good results. So the market cap is now only 100 million. That doesn't add a lot of value. Okay, because the enterprise value is 1.2 billion. So what is 80 million worth on 1.2 billion enterprise value? Nothing. So mainly oil price, look at the oil price and you will know what Frontera Energy will do. Currently overvalued. And that's it. I'll see you in the next video. Bye.